Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, April 4th, and then we'll see how things look for Wednesday, April 5th. We had probably one of the most anticipated pullbacks that we've seen in quite some time. The market was very overextended to the upside. We saw a down day on Tuesday. Now we have to start to look. Are we just pulling back before we're getting set to go higher? Or is this the start of something that actually is going to go in and switch the trend from being positive back down to negative? Before we get started in the video, please note that from April 22nd through May 11th, I will be traveling. If I can get my stuff across some kind of dicey border situations, I will be posting the daily video updates the best that I can, as well as some of the other videos. I've also launched a recent podcast on YouTube. It's a duplicate of what you're watching right now. And with not only the videos, but with the podcast, I have a PDF of the slides and the charts where you can follow along and look at the different things that I'm talking about. I also have a private Facebook group that you're welcome to join. If you're on Facebook, just go ahead and send me a request. You can also access this by clicking on the link below the video. I've also posted a poll. What I'm thinking of doing is once a week, we'll let this run for a week, then I'll bring up the results in one of the weekend videos, and then I'll repost for the next coming week. All right, let's go back and talk about what happened. Right at the open, we had a flat open with prices falling below the unchanged level and fell down below the daily pivot at 41.17. As the day went on, prices fell down below S1. They found support down at S2 at 40.88. From there, we were able to bounce back up to S1. Then, going into the close, prices fell back to close right at 4,100. We were down 0.58% on below average volume. So we were seeing below average volume on the way up, and so far we're seeing below average volume on the way down. The technicals are still very positive overall, but overextended. We're still signaling a lot of overbought conditions, so we'll just have to see. Are we seeing a shift or just a pause because of this inflation and interest rate concern? We're also wondering, is there going to be more with this whole banking situation? Here's the intraday chart showing how we had a flat open. We went below the unchanged level, down below the daily pivot. We fell through S1 all the way down to S2, bounced back up to S1, came back down a little bit lower, and then saw some late day buying that took us right to 4,100. Here's the growth versus value. They also were down on the day. Here's the closing chart showing how growth did a little bit better than value, being down less, where with the mid caps it was about even, and with small caps, which had a lot of weakness in Tuesday's session, the growth part of the small caps ended up being down more. Here's the SPY intraday chart. We were drifting a little bit lower with the futures contract during the night. Then we saw things really start to pick up. That fed over into the opening of the session, but then we just continued to drop after that. We chopped a little bit sideways, saw a little bit of bouncing coming into the close, and currently we are headed sideways. What are some comments that we can make? JP Morgan Chase's CEO, Jamie Dimon, who's a big rock star when it comes to the stock market, he came out with this annual shareholder letter. And he said in that letter that the regional banking crisis is not over and will have repercussions for years to come. When he talks, people listen. Now, he might say things that we already know about, but this adds validity to the whole situation. Small caps did underperform in Tuesday's session. There was a lot more weakness again in the banking stocks. Volume continues to be below average. And on a short-term basis, our list is getting a little shorter, but we have the Stochc RSI, the stochastics, the Williams %R, and the CMB Composite Index are still extreme positive. On an intermediate term basis, we have the McClellan Oscillator based on the S&P 500, the PMO study, as well as the CCI 14 and 20. The dollar was down, as were interest rates. The Home Builders ETF, that is still on the books. Once we register that divergence, now we wait to see how things will play out from there, even though the chart is showing some improvement, and I'll show that to you. We still have the 30 to the 5 that's going back to being normal, where the rest of our yield curves are inverted. Sentiment is still positive overall. It did drop with the down day. It had been at 60, where it came in at 50 after Tuesday. Our trend is still positive. The green line's on top, even though it declined. It's strengthening. We're moving above the moving average, but we're still trendless because we're below 20. I've changed our bias to mixed with the down day, but our momentum is still positive going back the last 2, 3, 4, 5 days. The economic reports that came out, we had factory orders down 0.7% on a month-over-month basis. They expected it to be down 0.5%. Last time we had the report, it came in up 2.1%. Shipments of manufactured goods were down 0.5% month-over-month. Last time they were up 0.3%. The JOLTS job openings came in at 9.931 million. This is the first time in a while that it's dropped below 10 million. This first chart just shows seasonality. How does April look? And looking inside this red box, that is how April tends to perform. It ends up being one of the stronger months of the year. This chart just shows the path of the Fed funds during previous hiking cycles. The interesting thing from this chart is how fast we've gone up in the current cycle. We've never seen that I can recall in history, where usually the Fed takes their time and raises interest rates more slowly. This time they just shot them up quickly. Of course, we were coming out of a situation that was far from normal after the whole COVID lockdown and the stimulus packages and the fiscal policy changes. The ISM Manufacturing Index has been declining, especially when you compare it to the purple line, the S&P 500. These tend to move in the same overall direction, so that could put some headwinds against stock prices moving higher. Looking again at earnings, the blue line is the S&P median stock forward PE, and that's been going up lately because the stock market has been going up. And then we have the S&P forward PE itself, the gold line here. They both have been advancing as the stock market has been going up. So now we're wondering, is the market going to become even more expensive than it already has become? This chart suggests that the 2-year yield is well below the Fed funds rate. And if you think about that, where are the Fed funds and where is the yield? This is a comparison between the two, showing that we're still underwater as far as where interest rates are at. The next chart shows that we're now in the fastest recovery since the end of World War II, which was the beginning of the Marshall Plan. Way over on the right-hand side, the light blue area is measuring how we've been growing since that time. We're also keeping an eye on the dollar on a year-over-year basis on this chart. And then we have the real 10-year yield, that's taking inflation into account, minus the 3-month, and then they advance at 1 year. They have some tendency to go in the same overall direction. Where the real yield has been declining, is that going to put some pressure on the dollar, which could give some support to stocks, but when the dollar declines, also emerging markets can become more attractive. Here's the U.S. terminal rate right now. It's saying it's at 4.96%. It has been going up. Now, other charts that we look at say that we're going to be well up over 5%. That's the rate at which the Fed stops raising interest rates and either keeps them there and then at some point starts to lower the rates. Edward Yardeni had a couple of interesting charts. The red line is the S&P 500 and the blue line is the U.S. manufacturing PMI, where it is really continuing to decline. The market has been bouncing back as of late. Will the PMI put pressure on stocks, or are we going to see some rebounding in this indicator going forward? We also had job openings, which have been decreasing. As I said, they fell under 10 million for the first time. And then job openings per unemployed worker has also been declining. U.S. motor vehicles fell just a little bit over the last month. Then looking at some of our charts, the Ulster Index still suggests that we're pretty complacent in the market. The VIX did go up slightly with the down day, so we ticked up on the line chart as well as the bar chart, but we're still well below 20. And volatility picked back up just slightly in Tuesday's session. The equity put-call ratio is starting to go back up a little bit now. We're still working off of this spike at above 0.8. As that was continuing to fall, that gave some support to stocks. If we continue to fall from here, we would expect this ratio to go back up. Another fear gauge that we look at also ticked up slightly on Tuesday, as did the other fear gauge that we keep a close eye on. The high beta stocks not really participating in this right now. We're still in more of a risk-off posture, meaning folks are getting out of stocks and into bonds. This is another new chart that I'm showing where we have the 1 to 3 month T-bill, which could be considered cash, against the tech sector. We're looking way over here on the right side. As this is falling, that's actually positive for stocks. When we start to see a lot of fear in the market, this will spike back up, and we're continuing to drop below the Ichimoku cloud. Our trend continues to get a little bit stronger. We're above the moving average. The green line's still on top, even though it did decline, but we're still below 20 overall. The daily chart shows how we came right up to this previous pivot level. That was overhead resistance, and then we have been falling back down. If we continue to fall, we'll keep an eye on this other pivot point, as well as the 50-period moving average, and then another pivot point right below that. You can see at the bottom where volume did drop to below average. Here's a 2-year look at that same chart. Not really showing us anything different here, just getting a longer look. The Arun is still continuing to show some improvement. We've crossed above zero. That's positive, showing the buyers are in control where sellers are dissipating. With our Keltner bands, we got up into the third standard deviation and we're starting to drop back down from that. When we got into that really high area, that marked that we were going up pretty far, pretty fast, and due for some kind of a pullback. The rate of change, 5 periods, had been extreme positive and is now starting to drop. The Stochk RSI is dropping, but it's still extreme positive, as is the Williams %R. The stochastics rolling over, but still extreme in the short term, also starting to roll over in the intermediate term, still showing improvement in the long term. The force index did decline, but is still positive. Looking at our moving average tree, we're still above all the plotted moving averages. The Swindlen trending oscillator starting to come off an extreme positive reading, turning down just slightly based on volume. All of our oscillators, though, continue to be positive. The parabolic SAR continues to be positive with the dots below. The Chaikin oscillator coming off an extreme positive reading. The Vortex continues to be positive. The Ultimate oscillator also coming off an extreme positive reading. The Sean trend meter is still extreme positive and going sideways, but could be showing signs of rolling over. The moving average study coming down from our 20, turned down slightly from the 50, as well as the 200. The CCI 14 and the CCI 20 are still extreme positive, even though they're dropping. The RSI is turning down a little bit, but it's still positive because it's above 50, where the RSI 9 has now dropped below the extreme positive reading. The ratio between the S&P and the utilities still is not going anywhere overall. This is more of a warning sign. In a good, healthy move with the S&P, we want to see the S&P really outperforming utilities. The Ichimoku cloud, so far, we're still above what could now be called support. The PMO continues to be positive, and the PMO study is still extreme positive with the PMOs that are rising. We're still extreme with the buy signals, and we're showing improvement with the PMOs that are above zero. The BPI continues to go up, and this is internally showing more strength. We're above 50 and still advancing. We're on a broader measure. We're also showing some improvement with the NYSE BPI. The Chaikin money flow continues to be positive. The balance of power coming down a little bit after giving us an extreme positive reading, but is still positive overall. The CMB is still extreme and has not fallen back below this black line. The TTM squeeze continues to show some improvement. The go, no-go is still positive. We're still above the anchored moving average going back to the all-time high. If we continue to fall at the 40.74 level, will that offer support? On a short-term basis, we came right up to this 100% retracement, and now we're starting to fall back down. On a longer-term basis, also showing some weakness and not really any close support or resistance. On a longer-term basis, we have overhead resistance at 42.14. If we continue to fall, we're back down to the 40.20 level. This chart you can also take two ways. We were really shooting up, showing that the big stocks were outperforming the smaller stocks, starting to come back down, but then bounced up a little bit. You could take this as positive, meaning that more stocks are now starting to participate, but if this really shoots up, it could mean that the big stocks are coming in and taking over again. The Elder Impulse system for the S&P has switched to neutral. The McClellan oscillator is still giving us just barely an extreme positive reading, and a broader measure is also coming off of an extreme positive reading. The summation index looking more positive. We're crossing above zero based on price. We already crossed above zero based on volume, so this is positive. The new highs, new lows continue to hold up fairly well with the 5 period as well as the 10 period. The advanced decline line decreased slightly. We're still seeing that negative divergence when you compare price with volume. The advanced decline ratio getting extreme with our 19 period and turning back down We're still positive overall with both the blue line and the red line. Accumulation distribution also moving back a little closer to the moving average, but is still positive. We're still seeing volume dropping off. The money flow index actually ticked up slightly, and that's positive and above 50. On balance volume came down, but is still above and now turning moving average. The Bollinger Bands, after getting to the outside, were starting to fall back down. This also measures that same thing after giving us an extreme positive reading. The Heiken Ashi remains positive, as does the Kegi chart, the Renko chart, the three-line break. All of those remain positive. We haven't seen enough of a down move for these charts to redraw. The boom indicator, after getting extreme on our 20-period moving average, is now starting to come back down. We're still showing some improvement with the 50 and the 200-period moving average study. Longer term, the 150 is turning down, as is the 200-period moving average. The financials continue to show weakness when compared to the S&P. And looking at the ratio between the regional ETF and the financial sector still shows that we're declining. Looking at the broad measure, the advanced decline line, on top is the NYSE coming back down and moving below the moving average. The S&P, although it did come back down, is not dropping below the moving average. The mid caps are turning down, and this is a concern. We're seeing some weakness in the small caps, which never made it up through this moving average. The Dow is still above its 50-period moving average, even though it did decline. The diamonds continue to be positive. The NASDAQ, we're watching to see, is this a potential double top right here, at least in the short to intermediate term? So far, that looks like it could be the case. If we break out to the upside, that would wipe that off. If we continue to fall, that would validate this observation. The NASDAQ 100 also is chopping sideways more or less. The Qs have switched back to neutral. The microcaps were also down. We're wondering if they're going to make a new 52-week low, so we're watching that. And here's a look at the small caps, which are down almost 2%. The Russell also shows the weakness as we came up to the 200-period moving average and have since bounced back down. The MACD is still positive, but we're dropping below 50 with the RSI. The Elder Impulse system now has switched to negative for the small caps. The small caps to S&P 500 ratio continues to show disintegration. And the mid caps came all the way down to the 200-period moving average and were able to close above that. And the mid caps for the Elder Impulse have switched to neutral. Here's the Home Builders ETF. We were down with the S&P. We were down with the Home Builders ETF. The ratio did decline, so it's showing some improvement, but we're still looking at this spike where we had that extreme negative reading. That could give some real overhead resistance to stocks. The Copic curve is still positive. The Pring Bottom Fisher is also generating a recent buy signal. Bonds really saw yields fall in Tuesday's session, where bond prices were up on the day and continue to be positive. Looking at our long-term trend, we're still seeing some improvement here. The MACD continues to go up higher, and it's above zero. That's suggesting that this breakout above this downward sloping trend line for right now appears to be valid. An update of our possible positive scenario saw a little bit of a pullback based on price and volume when you look at our 19-day exponential moving average of the advanced decline ratio. The 10-day average of the highs minus the lows also showing some improvement. When we look at the broad measure, we're still above zero when we look at the 5-period moving average of the highs minus the lows. And then checking out our growth to value ratios, the Qs held up better than the S&P. Discretionary is still having a little bit of trouble here, where large cap growth outperformed large cap value. Then looking at our growth to value ratios for the large, mid, and small caps, they're still hanging in there. When we look at our 50-period exponential moving average of the new highs minus the new lows, we're coming back above zero with the red line. So that's switching back to positive because the indicator on the next chart remains above zero. 2-year Treasury, after spiking and coming back down, that gave some support to stocks, and that might be coming off the table. And then our staples to S&P 500 ratio, we're still wondering if these two spikes here could be something that would give the market support. But for right now, the market appears to be pulling back. What's our outlook for Wednesday? The market will be closed on Friday. I'm still hearing that overall. The technicals are positive, but still mostly overbought. We have the weekly MBA mortgage index coming out, as well as the ADP employment change and the trade balance, as well as the final IHS market servicing PMI. And then the big one is going to be the ISM non-manufacturing index. Then we have the whole list of geopolitical events. Just wondering if there's more information that's going to come out concerning this banking situation. All of the speeches that were scheduled for this week have now concluded and didn't really have an impact on the market. Looking at the Stock Traders Almanac, I went through these bullet points in yesterday's video or in the weekly video. What I do talk about is how do things look for April 5th. The Dow, the S&P, and the NASDAQ are more neutral to negative, where the NASDAQ tends to be a little bit more positive. And then we tend to be positive for the month of April. Then on the next chart, these are the yearly backdrop things that we're watching right now that I go through periodically in the videos. Here's the chart showing for the pre-election years, we tend to have positive seasonality. We also see that on this next chart as well as the next chart. So our scenarios, can't really go with the down one because we're still pretty much positive overall, but we are still overbought. Can't go with the up one because we're overbought and still pretty far extended, and we're also not trending, so we go with the sideways trend because the ADX is strengthening, but it's still below 20, although we default to positive because the green line is on top. Looking at our warning signs, volume remains below average. The S&P is still mostly short and intermediate term overbought. The VIX, even though it ticked up, is still showing a lot of complacency. The S&P continues to underperform utilities. Small caps are really underperforming. The NASDAQ may be declining from a double top. We'll have to watch to see if it plays out that way. The home builders continue to show a negative divergence, even though that chart is showing some improvement. That's still on the table for right now. Our conclusion, the S&P is positive, but still mostly overbought. Same thing for the short term as well as intermediate term. Long term, we're still above the 200-day moving average, so we're positive, and we had that recent golden cross. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.